A very good afternoon. We're onto your markets now. We did see global markets trend upwards, doing much better than they had in previous weeks. And of course, we want to see if that momentum has continued. For more on this, let's now speak to Lukman Otunuga. He's a senior research analyst at FXTM. A very good afternoon, Lukman. Thank you very much for joining us. So what is the global sentiment right now? And have we seen markets continue to forge ahead relative to how they've been performing in past weeks?
Good afternoon. Thank you for having me here today. It's always a pleasure. Interestingly, markets in China, Hong Kong, and South Africa, South Korea are closed today, but we saw a positive start in the Asian region based on the strong close we saw on Wall Street last Friday. I think hopes of a softer U.S. inflation report on Tuesday result in the Federal Reserve adopting a less aggressive approach towards interest rates seems to be feeding into risk sentiment, and this is resulting in equities across the globe pushing higher. European markets are green, and according to U.S. futures, Wall Street expected to also open on a positive note on this narrative.
We keep on being asked at the economic desk, why is the rand so weak? 17.30 against the dollar or whatever it may be. But what is the broader story about the US dollar? Why is it strengthening not only relative to the South African rand, but other currencies as well?
So I've been really picking out the dollar, and interestingly, my thoughts on the dollar was, are dollar bulls ready to throw in the towel? Looking at the dollar's year-to-date gains, though, the dollar has steamrolled most G10 emerging market and major currencies year-to-date based on three major factors: interest rates, the U.S. economy, and the fact that the dollar is seen as a safe haven destination. The Federal Reserve remains the leader of the pack. It's pushed ahead with aggressive rate hikes and relative to other central banks. So this continues to support the dollar. When we look at the U.S. economy, even though there are recession fears, the labor market remains robust, and there's some pockets of positive economic data here and there also supporting the greenback. And finally, we have concerns of the global economy and recession fears sending investors towards the dollar's safe embrace. So when we combine these three factors, we see why the dollar is strong, not only against G10 currencies, but also against emerging market currencies, despite their respective central banks also joining the rate hike train in an effort to tame inflation. But with things moving forward, if you look at the dollar's performance over the last few weeks, especially last week, the dollar seems to be weakening despite Fed officials adopting a hawkish approach. I think because inflation seems to be slowing in the US, and I think further signs of inflation slowing in the US economy, resulting in markets pulling back bets over more aggressive rate hikes, could remove dollar bulls from the picture and bring bears in Q4 of 2022.
Now, we understand in the United Kingdom there are fears that inflation could go up as high as 20% or even exceed that, which is quite a worry. But I also understand that due to Queen Elizabeth III's passing, the Bank of England has decided not to make a call on interest rates this Thursday as it was supposed to have. What sort of impact does that have on market players, or it's business as usual and it's understood that come next week they'll probably release their decision?
It's business as usual, but there's a solemn mood that has enveloped the UK, with most people I've spoken to, including myself, feeling a deep sense of loss. Her late Majesty the Queen was a pillar of stability in the UK, heavily respected and constant. And with how things are right now, there is a sense of uncertainty in the air. And based on this uncertainty, this period of mourning, nobody really know what's going on. I think the Bank of England pushing just postponing the decision could give it more time to really, decide whether this is the right time to move ahead with another jumbo rate hike. There's a lot of things hitting the UK economy. Even though inflation seems to be slowing, we've got the uncertainty of a new prime minister, we've got post-Brexit related drama, household spending squeeze. There's many factors out there that could, tip the UK economy over the edge, with aggressive rate hike being that unwanted catalyst. So the Bank of England is really thinking things through whether to move ahead with raising rates by 75 basis points in an effort to tame soaring inflation, or moving just with a 50 basis basis hike, you know, in the effort to keep the UK economy floating above water. But in the meantime, though, I think uncertainty is the name of the game, and it's likely to be reflected in the pound against the dollar and other major G10 currencies.
Yeah. And very briefly, Lukman, of course, we've heard of the winter of discontent in the 1970s when oil prices skyrocketed and inflation skyrocketed, and it's almost like a replica right now. How concerned are you about the UK as well as the Eurozone region and how they're going to cope with the energy crisis as they go into their winter?
Certainly, I mean, starting with the UK though, like domestically, I'm always on the phone with my energy provider. We're always fighting. I'm looking at my bills and I'm asking, this doesn't make sense. But, you know, with the new Prime Minister, Liz Truss, she's actually set out plans to freeze energy bills at average of $2,500 a year for 2 years. So, you know, the prospects of energy prices, you know, prices for domestic consumers rising beyond that for 2 years. It's, you know, it's a welcome development and does ease the pressure, especially in households. But Europe is another ballgame entirely. You know, the European economy is facing a war. You know, we've got the news about Gazprom, you know, halting its energy supplies to Europe, many uncertainty, geopolitical risks. You know, things not looking really good for the European economy, and this could be a harsh winter. Moving forward, though, I think, you know, even though there are other places where Europe could get its gas, soaring gas prices are going to result in higher inflation. As inflation continues to rise, this is not only going to possibly tip the European economy into a recession, but force the European Central Bank to move ahead with raising interest rates aggressively by another 75 basis points constantly until inflation shows signs of moderating.
Lukman, thank you very much. Always great to get your insights. Lukman Otunuga, he's a research analyst at FXTM. We're going to take a quick break.